Hey everyone, and welcome back to Tech Fails, the channel where we dig into the biggest, most spectacular disasters in the history of technology. You see the headlines today: massive data breaches, failed product launches, billion-dollar startups crashing and burning. But some of the most insidious failures aren't about a server going down or a battery exploding. They're about how technology was weaponized, turned into a smoke machine to hide the biggest corporate lie in modern history. Today, we're talking about Enron. You probably know the name. It's synonymous with corporate fraud. But what often gets overlooked is how deep the technology component of this scandal went. Enron wasn't just an energy company. It was a digital powerhouse trying to remake the entire energy market. Its entire fraudulent business model was utterly dependent on a web of complex, cutting-edge, and ultimately opaque IT structures. It's the ultimate cautionary tale in technology scandals. It's the moment the tool of innovation became the instrument of deception. So, grab a coffee, settle in, because we're diving into the digital depths of the Enron collapse. This is the story of how a company that promised to revolutionize the future of energy instead just used its IT systems to build a facade of profits. To understand the tech fail at the heart of Enron, you have to understand its sheer ambition. In the 1,990 seconds, Enron, under CEO Jeff Skilling and Chairman Ken Lay, wasn't content just selling natural gas. They saw a future where everything was a commodity that could be bought, sold, and traded instantly. Gas, electricity, water, weather, and even broadband capacity. They wanted to be the Amazon of commodities. This grand vision required an equally grand technology infrastructure. They spent massive amounts of money building sophisticated IT systems. This wasn't just a ledger. This was a digital trading floor on a global scale. Think about it. They had to track real-time changes in energy demand across state lines. They also had to manage price fluctuations minute by minute and the complex contracts for future delivery. Enron's technology was genuinely groundbreaking for its time, creating a digital marketplace that simply didn't exist before. The key pieces of the puzzle were their vast digital platforms. First was Enron Online, or EOL. Launched in 1999, this was a massive, web-based platform that allowed thousands of counterparties to trade energy and other commodities with Enron 24/7. It was an immediate success, or at least it appeared to be. The trading volume was huge, validating Enron's push into the digital sphere. Second was their massive network infrastructure. They invested heavily in fiber optic networks, dreaming of trading bandwidth like barrels of oil. This led to the creation of Enron Broadband Services S, a multi-billion-dollar endeavor intended to be the backbone of the digital economy. The narrative was clear. Enron was a smart, future-focused technology company that just happened to be in the energy business. They positioned themselves as innovators, using technology to achieve efficiencies and profits no one else could. This rapid, tech-driven expansion created an aura of invincibility. It also created an enormous, incredibly complex pile of data and transactions. This is where the foundation of the scandal was truly laid. The sheer complexity of these systems, the interconnectedness of the trading platforms, the energy networks, and the high-speed data services made it nearly impossible for an outsider to track what was actually happening. This was crucial for their strategy. And here's the kicker. Enron didn't generate profits the old-fashioned way by selling physical stuff and counting the cash. They used a controversial accounting method called mark-to-market, MTM. MTM requires a company to book the potential profit or loss from a long-term contract the day the contract is signed. This profit is based on the estimated future value, instead of waiting years for the actual cash to come in. For a traditional company, this is risky. For a company trading highly volatile, new commodities like broadband capacity and weather derivatives on complex digital platforms, it was a recipe for catastrophe. This is where the IT infrastructure becomes the central tool of deception. Remember those complex trading contracts? The profits weren't real, they were projections. If the actual market price changed, the projected profit would disappear, creating a massive, ugly hole on the balance sheet. Enron's solution wasn't to admit the mistake, it was to use their digital architecture to create layers of financial complexity that no one could penetrate. The core of the accounting fraud involved the creation of thousands of what they called special purpose entities. These were essentially shell companies with names like Raptor, Jedi, and Shuko. They weren't just standard subsidiaries. They were vehicles used systematically to hide debt and inflate earnings. Let's look at the debt shuffle. Enron would sell its poor-performing assets, like its failing broadband services fiber network, to these SPEs. The sale would immediately remove the debt associated with those assets from Enron's books. Crucially, the sale would also allow Enron to book immediate revenue, often based on those overly optimistic MTM projections. Since the SPEs were not legally required to be consolidated on Enron's financial statements, the debt simply disappeared from the public eye. The complexity of Enron's own systems provided the perfect cover for this maneuver. Consider the sheer volume of transactions flowing through Enron online. The systems were designed to handle hundreds of thousands of trades a day, generating petabytes of data. This massive data flow, combined with the incredibly convoluted, multi-layered SPE structure, made it virtually impossible for auditors to connect the dots. The auditors weren't looking at simple paper ledgers. They were looking at data feeds, system summaries, and reports generated by Enron's own IT division. The data was so specialized, so deep within the proprietary Enron systems, that the auditors often had to take the company's word for it. They couldn't easily verify the real-world assets backing up the digital projections. It was a digital needle in a data haystack, hidden by the very technology that was supposed to increase transparency. The technology failed not because of a bug or a hardware malfunction. No, it failed because it performed its intended function to process transactions so perfectly, so quickly, and so voluminously that it created a shield of complexity. This shield of complexity effectively protected the lie. Beyond the accounting fraud, one of Enron's biggest and most dramatic technology failures was Enron Broadband Services, 1. This division was a huge, multi-billion-dollar bet on the future. The idea was to create a massive, nationwide fiber optic network and use technology to provide high-speed video on demand and other services, trading bandwidth like a utility. They spent fortunes building the network and developing the technology, including a proprietary operating system and streaming software. They hired some of the best technology professionals in the business, attracting them with the allure of a ground floor opportunity in a revolutionary space. But the execution was a disaster. The technology was overly ambitious and never worked as promised. They simply couldn't overcome the technical hurdles of sending high-quality, continuous video streams over the public internet at scale. And even if the tech had worked perfectly, the demand simply wasn't there yet. They were years too early for widespread, high-speed broadband adoption. The market had not yet caught up to their vision. The failure of EBS was critical because it was the source of some of the most egregious mark-to-market abuses. Enron booked huge, instantaneous profits on long-term contracts for the use of their network capacity. This was capacity that often didn't even exist yet. They were booking billions in projected revenue for a technology product that was fundamentally flawed and never delivered. As the division hemorrhaged money, the finance side became even more desperate. They cooked the books to keep the EBS dream alive. They used SPEs to hide the debt and selling off small stakes to create the appearance of value. This created a spiraling feedback loop that deepened the overall technology scandal. The failing technology project required more aggressive accounting fraud. This, in turn, relied on the complexity of their IT systems to hide the true losses. This is a classic example of a technology scandal where a failed technical vision directly led to criminal financial behavior. Despite all the layers of obfuscation, the truth couldn't be hidden forever. The system finally broke down not because of a technical failure in Enron Online or the trading platforms. It failed because the real-world cash flow, the hard data, couldn't support the fictional profits anymore. A series of investigative articles and an internal whistleblower, Sharon Watkins, finally forced the issue into the public. Once the investigation began, the irony was thick. That very same complex IT infrastructure that had been used to hide the fraud became the key evidence against them. While Arthur Andersen infamously shredded some paper documents, the bulk of the fraudulent activity remained. The records of the complex trades, the internal memos, the emails detailing the deals with the SPEs, these were all stored digitally. They were all still present on Enron servers. The subsequent legal investigation was a massive effort by the U.S. government. It required forensic experts to sift through terabytes of data from Enron's systems. They painstakingly pieced together the trail of digital breadcrumbs. This revealed the real numbers versus the reported numbers, the internal communications showing criminal intent, and the exact mechanisms of the debt shuffle. The technology that had been the ultimate cloak of secrecy ultimately became the ultimate witness for the prosecution. The data couldn't lie once properly interpreted. Enron filed for Chapter 11 bankruptcy in December 2001. Thousands of employees lost their jobs and their retirement savings, which were heavily invested in Enron stock. The subsequent collapse of Arthur Andersen, one of the big five accounting firms, was a direct consequence of its role in facilitating the fraud. This was enabled by the firm's failure to audit Enron's convoluted IT structures effectively. The Enron collapse became a watershed moment, leading directly to the Sarbanes-Oxley Act, or SOX, in 2002. This was a sweeping piece of legislation designed to prevent similar corporate and technology scandals in the future. SOX placed massive new regulatory burdens on public companies, particularly around internal controls over financial reporting. This is a crucial takeaway for us. Enron's complex IT was deemed so opaque and lacking in adequate controls that the government had to step in and mandate better IT governance and data transparency. It was a permanent shift in corporate finance. So, what's the ultimate lesson from the Enron disaster? From the perspective of tech fails, it's not just a story about greed. It's a profound warning about the relationship between innovation, complexity, and oversight. Lesson 1. Complexity is the new opacity. Enron proved that the more complex a company's IT systems and financial structures are, the easier it is to hide malfeasance. Complexity can be weaponized by those with criminal intent. Regulators, investors, and even employees must demand clarity and transparency, especially when a company's profits are based on proprietary black box technology. Lesson 2. The limits of innovation. Enron embraced innovative technology trading platforms, mark-to-market accounting for new commodities, but lacked the ethical and financial guardrails to manage the risk. Innovation without integrity is just a faster way to commit fraud. A technology scandal often begins when technical ambition outpaces ethical accountability. Lesson 3. Governance matters. The Sarbanes-Oxley Act, born from this historical technical disaster, forced companies to take their IT controls seriously. This included things like user access and change management. Today, compliance mandates that the data flowing from a company's systems to its financial reports must be accurate, traceable, and secure. Enron's failure permanently changed how IT departments are governed and audited. The Enron scandal stands as one of the most significant technology scandals in history. It wasn't a product that failed, it was the system itself. They built an intricate, sophisticated digital world, not to create value, but to obscure the lack of it. They weaponized complexity, and in the end, it was the truth, captured in the very technology they created, that brought the whole empire crashing down. Thanks for joining us on this deep dive into digital deception. What other complex technology, scandals, or failed projects should we cover next? Let me know in the comments below. Don't forget to like and subscribe to Tech Fails so you don't miss our next story of technical hubris gone wrong. We'll see you next time.